Good morning. Nice to have you with us. Joined us here today at SB Financial Group, State Bank here in Defiance, Ohio. My name is Mark Klein, Chairman, President, and CEO of SB Financial Group and State Bank. Joining me this morning is my cohort, CFO, Tony Cosentino. And we wanted to do what we feel is responsible today in light of the recent three bank failures that aggregated generally around $500 billion in assets. And we wanted to have a casual conversation with all of our stakeholders with regard to what has happened in the market, what do we attribute it to, and how that potentially is significantly different from someone like State Bank, and how we view ourselves as a community bank. As many of you know, what led up to the demise of several bank failures is the fact that there was unprecedented stimulus through monetary policy, as well as fiscal deficit spending, which led to historically very low rates. And those rates led to very prominent and very robust economic activity, which again led to very high inflation and very low unemployment. And the only way the Fed is going to get things under control would be to continue to raise rates dramatically. And when that was done in very short, unprecedented period, that obviously was met with all banks of angst in terms of the impairment of the securities portfolio, which again, primarily for banks, is for the purpose of providing liquidity. When you have depositors and you have individuals we make loans to, and those depositors fund those loans, when you have a need for liquidity, you've got to be able to find the sources of that liquidity. And as you might expect, when those rates went up on unprecedented scale, and some of those banks that are now no longer with us attempted to find that liquidity by potentially liquidating securities that were low rate and underwater. And that was met with obviously unprecedented resistance in terms of recognizing losses in that portfolio that no longer could be used as liquidity. So wanted to again reconcile what's going on in the economy, what's happening with interest rates, how's that affecting all banks, more prominently how it affected the three banks that I mentioned before, around $500 billion in assets in the aggregate, and how that's different for community banks, and what is that saying about future regulations, future interest rates, future liquidity potential, and how we're making sure that as a 120-year-old bank here in Northwest Ohio and Southern Michigan and Northeast Indiana, what are we doing to remain relevant, to remain resilient to the market, and make sure that we're taking care of all of our constituents. And interesting to note, Tony, we've been a community bank for 120 years. We're proud of that. We've developed about 37,000 households, and we've never taken government stimulus or TARP money. Even in 2008, when the government came out with offering lower rates to prop up liquidity and capital, we never participated.
Exactly, and I think, to our credit, we've gone to the capital markets several times to raise capital, but we've always done that in a public manner, in a private manner. We've never had to go to government resources. We've not done anything unique or different during this quote unquote kind of banking crisis. We've not had to gone to the Fed to borrow money. We used our normal means of funding the company through retail deposits and then some local wholesale borrowings like all banks do. So we feel very good about our position and what we've been able to do.
Yeah, and generally speaking, one of the major differences between some of the banks that are no longer with us and our company is that we've built our company on individual households, individual businesses, generating again 37,000 households, where we actually did it with households and small businesses, roughly about $25,000 per deposit account versus $1 million or so per deposit account. And of course, when you're trying to find liquidity at all cost, that flies in the face of some logic, because you can't just go get the money when you need it. And I think we would agree that we've got good stability with our deposit base.
Exactly. In fact, we have a number of regions throughout, as Mark talked about, throughout the our communities, and we're not reliant on any one to provide the bulk of our funding. I think our largest region has about 26% of our total deposits. So not only is our loan book very diverse and geographically diverse, but also our deposit base. So that allows us to not suffer if one community has a downturn.
Right.
Whereas the three banks that have gone under were really concentric and concentrated with not only certain types of clients, but in certain areas. And once those areas and clients went under, that's when it went south for them.
So a major difference would be that we've made our loans and we've built our book, some 600-700 million over the last decade or so. We've built our book based on good traditional proven underwriting criteria, which would be based on traditional cash flow from businesses through operations versus venture capitalists or venture capital money or private equity money
or crypto
kind of businesses on the East Coast from Signature, those kind of things. So our portfolio, we feel, continues to be very strong and very diverse, which gives us a good diversity in our revenue as well. And we're not tied to paying loans back by virtue of more venture capital.
Yes.
Fair statement?
Absolutely. And I think that's has been and always has been one of our strengths, not only our diversity of revenue, but the diversity of our customer base. And that is a big difference between us and the majority of community banks and those banks that have failed.
Yeah. And when we've built our company on small businesses and the households one at a time throughout Northwest Ohio, and again aggregated 37,000 households, basically when you look at our insured deposits that have given clients stability and safety concerns, FDIC insurance goes up to many millions if you do the structuring right. But that said, if you look at insured deposits that we have, that gives our clients a lot of comfort. We have maybe 15% of our $1.1 billion deposit base that might be classified, quote unquote, as uninsured, where the banks that grew 40, 50, 60, 70% per year really quickly built their company on hot money, which became uninsured deposits. And when they're uninsured and people get angst, they want their money right away, which we feel our base and how we built our company is more on the smaller client, smaller business kind of a platform, which is a big difference between the banks that are not here any longer.
Absolutely. And that has been, historically where we've been. We've always been kind of that uninsured or level in the low to mid teens. Very small percentage of our total deposits exceed that 250,000 barrier. And even those that have, we've structured them through a number of products that allows clients to have full FDIC coverage, even when they might have millions of dollars here with us. And we've been very successful with that and continue to be. And we have not seen deposit outflows of any real material nature. In fact, our deposits have grown since the end of the year, and since the midpoint of 2022, our deposits overall are higher today.
Yeah, and we've certainly, as everyone knows, when rates were near zero, clients were not really getting much of a return on their deposits at all, and that has certainly changed. And certainly liquidity and profitability pull in different directions. We have to pay up for the money to make sure that our depositors remain content and with us as a depositor. But that said, we continue to work to make sure that we stay relevant to our deposit base, because if you look at our average account, which is I think we said about 25,000 per depositor account, versus some of the larger banks that are probably hundreds of thousands or even millions. So there's a big difference there when clients need or want their liquidity or feel unsure about the general landscape and the economic effects of where we find ourselves. And when we look at liquidity, if in fact rates are higher and our securities portfolio is not available to fund that liquidity because they're underwater, a little bit of ours is, albeit a very small percentage of our capital. With regard to banks that are no longer with us, the three that failed, and their securities portfolio went underwater as rates went up, we don't have that level of impairment like they might have, which ours might be the 15 to 20% of impairment, where theirs was roughly 100%. Took all their capital away.
Exactly, and one of the government programs that has been put in place is the ability to use those underwater securities, if you need them, as another borrowing capacity with the Federal Reserve. Again, we haven't had to use that, as I talked about earlier, but our contingent levels of liquidity, meaning money that we could come up with, is nearly 50 to 55% of our total deposit base, which is a really, really strong number, and one that we could use in really a tough time, but we don't anticipate that because of not only the loyalty, but the strength of our deposit base that we have today.
Yeah, so great client base, very high level of insured deposits, nice portfolio underwritten according to traditional bank standards versus venture capitalists and crypto kind of things. Building our company one client, one small business at a time, and making sure that we've got the liquidity available for our clients when they need it is really what's driven our franchise to, again, make sure that we remain relevant to all of our stakeholders. So, kind of in summary here, we understand that the next chapter has to be written and identified, but we think we have a lot of great attributes that make us a great community bank that services all of our stakeholders, from our staff to our clients to our community to our stockholders. And our job, again, is continue to drive value higher, and we seek to identify strategies to make sure that happens. But one thing that we definitely feel might be a bit misrepresented is the fact that we don't think that more regulations is going to legislate any better performance of the community bank. The bank insurance fund that was built up over the last decade certainly has some need to be built back up, and we don't feel that that should come generally on the backs of the community banks that have stuck to their knitting, if you will, and have done the right thing for all their stakeholders. And there's going to be some balancing, if you will, of the burden that's going to be placed on recapitalizing that bank insurance fund that is now a few billion less than what it was before. But that said, we think that management should be held responsible and accountable for the performance, and we're trying to make sure that we're communicating responsibly to our stakeholders and making sure that we have the liquidity, that we have the capital, we have the deposit base that's going to continue to make us relevant to all of our stakeholders. And we just wanted to make sure that our stakeholders understand that there's a big difference in the marketplace with regard to what's happened with the recent bank failures, and what they can look for and what they can look to their community bank, and being relevant again to all of our stakeholders as we move forward here. So thank you for joining Tony and me this morning for a conversation about where we find ourselves, and we look forward to determining how it is we can be more relevant to you here in our market in Northwest Ohio, Southwestern Michigan, and Northeast Indiana. Thanks for joining us.